Yeah, hi, good evening, friends. Welcome to our latest edition of the Passive Speak. A lot has happened between the last edition. The budget, union budget also was a big event which happened. And today here we are going to talk about our latest offering, which is the HDFC Nifty Multicap 50 25 25 index. And we are going to cover this product in our presentation. Uh, as the name suggests, this is Nifty 500 index that we're going to cover in the presentation today. And this is a new strategy to invest in this Nifty 500, which typically invests across market caps, that is large caps, mid caps, small caps. And then we'll proceed with the presentation. Yeah. Okay, so India is a great investment opportunity for many decades to come because we are one of the fastest growing economies, large economies in the world. The capex recovery has first been led by the government, and now even private sector is increasing their capex. There are large unmet needs of infrastructure which are there in our economy, which is being met by the government. The momentum of the reform process, which has been initiated and which has been in place for the last 10 years, is very strong. Uh, India is very rich in natural resources, so that gives us an advantage over economies who don't have a very vast resource of natural resources. There is a shift which is happening today in the manufacturing sector, which is favoring India because a lot of large manufacturers globally are now coming to set up manufacturing facilities in India. The government has announced PLI schemes to encourage manufacturing, and that is also helping in sustaining the economic momentum which is there. We also have favorable demographics because of the large availability of skilled young people, English speaking people, and that helps us because the working age population is very large in India. We for the population of our size, we compare very favorably with countries like China, for instance. Lastly, the rising income levels and low penetration of the consumer goods will help us sustain demand because on many metrics or parameters, the penetration of white goods or vehicles or whichever are the main, what you call parameters or indicators of consumption, India still has a long way to go because the levels of penetration are much lower as compared with other countries uh, if we look at the trajectory of the economic growth. The next slide. Okay, so what is this large, mid cap, and small cap? So, in this Nifty 500 index, we will be covering basically three segments of market cap. One is the large cap segment, which comprises of the top 100 stocks in the Nifty 100, so to speak. These are called large market capitalization companies. Then we have stock number 101 to 250, which are the next 150 companies, which are commonly referred to as mid-cap companies. And they form part of the Nifty Mid-Cap 150 universe. And lastly, we have the Nifty Small Cap universe, which is from stock number 251 to 500. So the 500 is broken up into 100 large cap, 150 mid cap, and 250 small cap. So through one product, you're getting exposure to three segments of market cap in the what do you call market in the market. Okay, so why should one invest across market caps? What is unique about each of these market caps? We have tried to cover this in this presentation. So as the name itself gives away the allocation, 50% allocation would be to large caps, 25% will be to mid caps, and 25% will be to small caps. So large caps are, as mentioned earlier, the top 100 companies by market cap. Generally, these companies have established their business over many years. They have been market leaders in their segments for many, many years. They are very stable, and the volatility in the prices of these stocks is much lower as compared to the broader market. And these companies are basically amongst the largest companies in India, and they are market leaders in their segment of business in which they are present. So the key sectors which are there in this large cap universe are the banking sector, IT sector, and the auto sector. These are some of the sectors which comprise of a maximum number of names from this large cap universe. Then we have the mid cap section, or the mid cap universe. The mid caps comprise of companies from 101 to 250. That's the mid cap universe. These are mid-sized companies. They would be future market leaders. They are a little bit more volatile as compared to large caps, if one has to make a comparison with large caps. And the key sectors within the mid cap universe is the industrials, non-banking finance companies, the NBFCs, and auto ancillaries. So these are some of these sectors from which these companies are there in the mid cap universe. Then we have the small caps, which is the 250 first company onwards, right up to 500. These companies are in niche businesses. They have the potential for growth. They are more volatile, and their liquidity, if you compare with large cap and mid cap, is much lower. The floating stock is much lesser. The key sectors from which these companies are present are chemicals, hotels, media, and entertainment. So this is the broad lay of the land in this large cap, mid cap, and small cap universe that I spoke about. Next slide now. Okay, so what we wanted to say is that, the market leadership, industry leadership comes in all sizes. So there could be companies which are large cap companies, which are market leaders in their space of business. There could be companies which are in the mid cap universe, which are leaders in their business. And there could be companies who are small cap companies by market cap, and they are also leaders in their business. So just to give you some examples of the sub-industry classification, in large caps, we have in consumer finance, one of the largest finances of consumer durables or white goods, as they're known. In construction and engineering also, we have one of India's biggest or premier infrastructure developers. In the food retail segment, we have a company which is a large cap company, which is a leading supermarket chain. In metals and mining, we have a company which is a leading mining company. In the mid-cap segment, we have a company in the personal product segment, which is a multinational FMCG in who's a leader in oral care products. In tires and rubbers, we have a tire manufacturer company, which is the largest tire manufacturer company, but it is a mid-cap company. In auto parts, we have the largest battery company in India, which is also a mid-cap company. In application software, we have a leading global design and technology service provider. In small cap, we have a leading Indian textile and branded apparel company. And in healthcare, we have a large and only multinational chain of pathology labs, which is a small cap company. So as you can see, different businesses have different leaders in different market cap segments. So industry leadership, to summarize, comes in all sizes, and you get exposure to each of these market caps. So you will get exposure to the market leaders in each of these businesses. Next slide. So if you look at this comparison that we have made, we have taken the Nifty 100 total return index in the last 19 years. We have taken the Nifty mid cap total return index, and we have taken the Nifty small cap 250 total return index. And we have given the financial year wise comparison for each of these 19 years. So if one looks at the chart, wherever the shaded area is green, that means that segment has given the best returns in that financial year. And if it's shaded yellow, it has given the second best returns, and if it's shaded red, it is given the least returns of the three indices which are covered in these three columns. So if one looks at this particular chart, you will notice that at different points of time, different indices have done well, and some have not done as well at that time. So if you look at the summary table on the right hand side, there are six instances where Nifty 100 returns were the highest in that particular financial year. And there were four instances where the Nifty Mid Cap Total Return Index were the highest returns in these 19 years. And the Nifty Small Cap Index basically was the highest, gave the highest returns, or was the best performer in nine of those 19 financial years. And the Nifty 100 Large Cap Index was the second best performing index in four of those 19 years. The Nifty Mid Cap 150 TRI was the second best performing index over 12 of these 19 years. And the Nifty Small Cap was the second best performing index in three of the 19 years. And if you look at the lowest returns, the Nifty 100 gave the lowest returns in 9 out of these 19 years. The Nifty Mid Cap Index gave the lowest returns in three of these 19 years. And the Nifty Small Cap Index gave the lowest returns in seven of the 19 years. So the winners among large caps, mid caps, and small caps keeps changing, which so that makes sense to have exposure to all three segments. It makes eminent sense to invest across the market cap segments because the winners keep changing, as we can see this chart of the last 19 years. Okay. So now we come to the methodology of the index. As the name of the index is the Nifty 500 Multicap 50 25 25 Index, there will be 50% exposure to large caps, 25% to mid caps, and 25% to small caps at all points of time in this particular index. There are 500 stocks, and the rebalancing will happen on a quarterly basis so that we maintain this 50 25 25 ratio. And this rebalancing will happen in March, June, September, and December. So what do I mean by rebalancing is that if the ratio gets skewed in any of these what you call market cap segments, every quarter we look at that ratio. Suppose a large cap went to 60% because it did very well as a segment, and the allocation to mid and small has come down. Then what will happen is that in the rebalancing, large caps will come back to 50 and mid and small will come back to 25. So this rebalancing will happen automatically every quarter. And how this is beneficial to an investor is that because of this automatic rebalancing which happens at the scheme level, the scheme does not pay any tax on this churn which happens on account of rebalancing. If an investor was to invest in three funds and were to keep changing the allocation to large, mid, and small, there would be an incidence of tax whenever he redeems money from one particular segment and invests in the other segment. So this is a very tax efficient way for the investor to maintain this allocation. And there is an automatic profit booking, or there is an automatic buying where one of the particular market cap segments level has gone down or up. So this fixed ratio helps you get an automatic what do you call method of maintaining your allocation and doing it in a tax efficient manner. I now hand over the presentation to my colleague Shikhar. He will take you through the finer points of this particular product. Over to you.
Yes, thank you, Sandeep. So just building on from what Sandeep mentioned about this fixed 50 25 25 weightage. So this slide is really showing you, what the net impact of this weightage mechanism is. So if you were to look at the chart, what it's telling you is that in the normal Nifty 500 index, right? So 73% of the weight is in large caps, but in the multi-cap version, this multi-cap 50 25 25, that weight is 50% by design. So what is happening is that you are actually getting less overall weight to large caps, and in return you are getting more weight to mid caps and small caps. So for example, mid caps have a weight of 25%, that is up from 18% in the Nifty 500, and small caps have a weight of also 25% in the multi cap index, up from 10% weight in the Nifty 500. So just to summarize, 50 25 25, very, sort of easy to understand, means 50% weight to large, mid, and small, to large, 25% to mid, 25% to small. And in practice, this means that as an investor in the multi-cap version of Nifty 500, you are getting less exposure to large caps, but more exposure to mid cap and small cap. So if you are, an investor who sort of believes in the growth potential of mid and small, and you think, that these are the parts of the market which can really grow and help create your wealth, this product sort of gives you higher exposure to the mid and small segment and a lower exposure to large caps. So in a way, it's a quite interesting proposition, because now in a single product, 50% of your weight is, in the stability of large caps, the relative stability of large caps, and 50% of your weight split across 25% mid, 25% small, is in the higher growth potential. So that it's giving you a sort of very interesting allocation, this split between the growth segments of the market and also the stable large cap segment. So now, if we were to just get a feel of, what the index looks like, what are the actual constituents? So we already know that the same 500 stocks that are in the Nifty 500 index are also in the multi-cap version. Only difference is that the weightages are changed, as we've just described over the previous few slides. So that's why it's no surprise if you look at the top 10 constituents of the multi-cap index. It's again HDFC Bank, Reliance, ICICI, Infosys, so on and so forth. These are all your large cap names. But what is the difference? You can see here clearly in the weightage column. So in the normal Nifty 50 or Nifty 100, for example, HDFC, Reliance, these kind of companies would have a weightage of more than 10%, right? But because this is the multi-cap 50 25 25 version, you can see that the weights are much lesser here for large caps, and that reduction in the weight for large caps is then taken up by mid and small. And that's why, this same feature is kind of visible in the sector distribution as well. So there are not very big differences between the multi-cap and the Nifty 500 in terms of sector composition, but where they exist, right? So the multi-cap version has slightly more, about 2.9%, 2.9 percentage points more of capital goods, healthcare, and chemicals compared to the normal 500. And similarly, it is underweight FMCG, oil, gas, and financial services, by about anywhere between 1 to 3 percentage points. So, simplistically, the reason for this is that capital goods, healthcare, chemicals, these are sectors which tend to have more of a weight in the mid cap and small cap segment of the market. So they are getting a higher weight in the multi cap version as well. And vice versa, sectors which are, dominating the large cap part of the index, so your FMCG, oil and gas, financial services, these are getting lower weights overall. Okay, so now we can move to the return section. Here, what we observe is that since inception, so since the multi-cap index has an inception date of April 1, 2005, it has outperformed the Nifty 500 index. So the multi-cap version has given approximately 16.9% compounded annual growth rate versus 15.4% for the Nifty 500. And not only just since inception, you will see that even over the last 1, 3, 5, 10 year, for example, the multi-cap version has performed better. Again, what has been driving this is that because it has a higher weight of mid and small compared to the Nifty 500. And mid and small segments have generally done very well over the last few years. That is showing up in the multi-cap version as well. So overall, over pretty much any time horizon you can look at in this chart, the multi-cap version has done better than the Nifty 500. It has benefited in a way from the growth potential from mid and small because it has a higher weight to these segments. Um, uh, this slide is now showing you the three different indices compared by financial year. So if we just look at the table on the right, what it's telling us is that in the 19 financial years we've had since financial year 2006 till financial year 24, in the majority of the years, that is 12 out of the 19, approximately 63% of the time, the multi-cap version has done better than the Nifty 500. So you can see here again, no surprise, years generally when the mid and small segments tend to do well also tend to be good years for the multi-cap. So FY 14, 15, 16, recently also FY 24, 21, 22. These years, these are the years in which the multi-cap has done better than the normal 500 index. And again, that has been driven by the strong performance of mid and small caps in those respective financial years. Last slide from my side. This is discussing the rolling returns. So again, giving you an idea that the on average, the rolling returns over different horizons are better for the multi-cap version than compared to the Nifty 500. So this difference is anywhere, from around 1.2 percentage points to little over 2%. For example, for the 3-year period, that this number of 14% means that over any 3-year rolling period, for which we have data from 2005 onwards till now, on average, the multi-cap index has given you 14% return compared to 12.56% for the Nifty 500. So, on average, the returns have been higher with the multi-cap version, but it's worth highlighting that these higher returns have come with a higher standard deviation, or basically with more risk. So, again, if we look at the 3-year period, well, the standard deviation of these rolling returns is higher for the multi-cap version. It's 9.3% compared to 7.8% for the Nifty 500. So, in effect, while the returns profile has been higher on average, it has come also with some degree of higher risk. So investors need to keep this in mind while deciding their allocation. That in general, again, because the product has historically had higher weight to mid and small caps, it has tended to be more volatile as well. Undoubtedly, that has led to overall better returns, but that has come with higher volatility. So investors should keep that in mind when making their investment decision. So I'll hand it back to Sandeep here.
So can you just scroll down to the, okay, this is it.
Yeah,
Okay,
yeah.
so to summarize, basically the key points for our presentation we covered now in the last half an hour is that the India growth story is intact. This product is ideally suited to cover all segments of the economy because it has got exposure to 500 stocks, which are diversified across market cap segments, sectors, lines of business. So it's a pretty broad-based index where you get coverage across the economy. And the second point is that you are able to diversify across three market cap segments, which is the large cap, mid cap, and the small cap segment. As we have seen in the earlier slides, that the winners keep changing every year. So if one invests across market cap segments, the chances of one capturing the returns across these segments improves quite dramatically. So it is warranted that you take exposure to a product which has got large, mid, and small cap in its universe. As we had explained, and as the name suggests, this is a 50-25-25 index. The normal Nifty 500 index is a market cap weighted index where more weightage is given to the large cap segment, then to the mid, and then to the small. Here there is a fixed allocation, a larger allocation to large caps, 50%, but there is an equal allocation of 25% to mid cap segment and to small cap segment. So what is fixed allocation does is it helps us to rebalance. I mean, it has to rebalance this on a quarterly basis. So you get a automatic rebalancing which happens every quarter, and here the scheme does it because this is a scheme which is doing it, not the investor himself. So that's why it is tax efficient, as a scheme does not have to pay any tax on reallocation of amongst these three market cap segments. So there is a automatic profit booking which happens because of this fixed allocation, but that happens in a very tax efficient manner. That is one of the key advantages of investing in this kind of a multi-cap Nifty 500 index. And the segment of mid caps and small caps has done very well over the last 3 to 4 years, by virtue of which even the 10-year return of this index looks better than the Nifty 500 and the Nifty 50. So the current breakup of the Nifty 500, if one has to make a comparison, this index has got lower exposure to large caps, but higher exposure to mid and small caps. So if one has a long-term view on the India growth story, and it can benefit from the various market cap segments which are available, this product will help you capture that growth across the market cap segments. Lastly, this is a low cost, it's an index fund which basically is mirroring the underlying index, which is the Nifty 500 Multicap 50 25 index. So the cost of what you call running this fund has been kept low. And so this low cost of managing this fund will help add to the overall CAGR of investing in such a product. And okay, I think I think it's a good time then to wrap up the presentation.
Definitely.
Okay, thank you everybody for attending this presentation. Hope you found it useful. The name of the product is HDFC Nifty 500 Multicap 50 25 25 Index. The new fund offer opens on 6th August and closes on 20th August 2024. And you can visit our website or our app to invest in this fund, or you can contact your distributor, or you can go on their portal, whatever it may be. It's available everywhere. Thank you. Thank you very much for attending the presentation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.